Topic focuses on benchmarking and performance attribution within alternative investments. Benchmarking provides a framework for evaluating manager performance relative to an appropriate reference portfolio or investment objective. Because alternative investments often involve illiquidity, leverage, non-traditional strategies, and limited transparency, benchmarking them is more challenging than benchmarking traditional assets. The topic explains that performance attribution helps investors identify the drivers of portfolio returns and distinguish manager skill from market-related factors. Understanding the sources of return is critical for evaluating active management effectiveness, risk exposures, and investment process quality. The program emphasizes that accurate benchmarking improves manager selection, portfolio construction, risk management, and overall investment governance. A major concept introduced in the topic is the hierarchy of alpha, which categorizes investment returns based on the degree of skill and market efficiency involved. At the top of the hierarchy are highly specialized opportunities requiring unique expertise, limited competition, and significant manager skill. As strategies become more widely understood and adopted, excess returns decline and eventually resemble beta exposures rather than true alpha generation. The program explains that due diligence priorities shift as strategies move down the hierarchy. For highly specialized strategies, investors focus heavily on manager talent and expertise. As strategies become commoditized, the emphasis increasingly shifts toward implementation efficiency, process quality, operational controls, and minimizing investment costs. The topic also examines manufactured alpha, particularly within private equity investing. Manufactured alpha refers to returns generated through operational improvements, revenue growth, margin enhancement, and strategic business transformation rather than simple market appreciation or multiple expansion. The program explains that allocators should analyze the underlying sources of value creation to determine whether performance reflects manager skill or favorable market conditions. Private equity return bridges are commonly used to disaggregate performance drivers into revenue growth, operational improvements, leverage effects, and valuation multiple changes. Multiple expansion alone may not indicate genuine skill because it can result from broad market movements rather than active value creation. This analysis helps investors evaluate whether returns are sustainable and manager-driven. Benchmarking and performance attribution require selecting appropriate benchmarks that accurately reflect an investment strategy's objectives and risk exposures. The program discusses the Bailey criteria, which identify important characteristics of effective benchmarks. Useful benchmarks should be unambiguous, investable, measurable, appropriate, specified in advance, reflective of current investment opinions, and owned by the manager. Active return is defined as the difference between portfolio performance and benchmark performance. Performance attribution models then decompose returns into allocation effects, selection effects, and interaction effects. Investors use attribution analysis to determine whether excess performance resulted from asset allocation decisions, security selection skill, market timing, or unintended factor exposures within the investment portfolio. The topic further explores single-factor and multi-factor models used to analyze alternative investment returns. Single-factor models typically evaluate portfolio sensitivity to a broad market benchmark, while multi-factor models incorporate exposures to style, sector, macroeconomic, and systematic risk factors. Multi-factor frameworks, such as the Fama-French model, help investors better understand sources of return and risk. Alternative investments frequently exhibit nonlinear return patterns, illiquidity effects, and dynamic exposures that complicate traditional regression analysis. The program highlights challenges, including serial correlation, model specification risk, and changing factor sensitivities over time. Accurate factor analysis is particularly important in hedge funds, private equity, and real estate, because these strategies may contain hidden leverage, illiquidity premiums, and evolving risk exposures. The program concludes by examining benchmarking approaches for commodities, managed futures, private equity, peer groups, and real estate investments. Commodity benchmarks often use futures indices that account for roll yield, collateral returns, and spot price changes. Managed futures benchmarks may include CTA indices or risk-adjusted peer comparisons, though strategy diversity creates benchmarking difficulties. Private equity benchmarking frequently relies on internal rate of return, IRR, public market equivalence, PME, and peer group quartile rankings, although differences in vintage years and valuation methods complicate comparisons. Real estate benchmarks may use transaction-based indices or appraisal-based indices, each containing unique biases and limitations. Overall, alternative asset benchmarking requires careful interpretation because illiquidity, smoothing, leverage, and heterogeneous strategies can distort conventional performance measures.